Welcome to Learned B Accounting Tutorials. Today we are starting a series on consolidated financial position. In this series, we're going to be solving different questions on consolidated financial position that is going to help you through your study and familiarize yourself with different ways a question can come. Whether you are writing ACCA, ICAN, or just practicing on your normal school work, these videos are going to be very useful to you. Today, we're going to be solving a question on subsidiary, associates, and exchange of shares, and other concepts in consolidated financial position that you might find complicated. This question we're about to solve was adopted from ACCA 2007 December Diet Financial Reporting. So I'm going to read this question, no? And it says, on the 1st October 2006, Plateau acquired the following non-current investments: 3 million equity shares in Savannah by an exchange of 1 share in Plateau for every 2 shares in Savannah. It was 1.25 per acquired Savannah shares in cash. The market price of every Plateau share at the date of acquisition was $6, and the market price of every Savannah share at the date of acquisition was $3.25. 30% of the equity shares of ACCA at a cost of $7.5 per share in cash. Only the cash considerations of the above investments have been recorded by Plateau. So I'm just going to underline some keywords. In addition, $500,000 of professional costs relating to the acquisition of Savannah are also included in the cost of investments. So let's just asterisk this because this line is of good importance. The summarized draft of the statement of financial position for 3 companies at 30th September 2007 are. So this is the separate financial position for the 3 companies. Plateau being the parent company, Savannah being the subsidiary company, and ACCA being the associate company. You may ask me, how have I come to this understanding that Savannah is the subsidiary and ACCA is the associate? Now, this understanding is all stated at the top here, where it said 3 million equity shares in Savannah was acquired, and then 30% of equity shares of ACCA. So we know that the condition for associates is usually 20% to 50%, and the condition for a subsidiary is usually greater than 50%, right? So now, based on this, we can see that since they acquired 30 shares in ACCA, that means the ACCA is an associate because it is within the condition for associates, right? Then, how do we know that Savannah is a subsidiary? If you come to the equity of Savannah, you can see the equity shares total in Savannah is $4,000, and then the nominal share price is $1. So if you divide through, that is 4 million shares because of the 000 at the top. So now 4 million shares, and they acquired 3 million equity shares. That's just going to be 3 million divided by 4 million, and this will give us 75%. So this is clear. So now that's what I used to establish that Plateau is the parent because he bought in these 2 companies. Savannah is a subsidiary of Plateau, and ACCA is an associate of Plateau. Let's keep on reading the question. This is the statement of financial position, and then the additional information. So the additional information says the following information is relevant. At the date of acquisition, Savannah had 5 years remaining of an agreement to supply goods to one of its major customers. Savannah believes it is highly likely that the agreement will be renewed when it expires. The director of Plateau estimates that the value of these customer based contracts has a fair value of $1 million. This pounds is a mistake, so we can just cancel that the pounds is a mistake. $1 million, and indefinite life, and has not suffered any impairment. So based on this information that we just read, we can tell that this is an intangible asset, right? It is identifiable and it can be measured. So this is an intangible asset, and then it is measured at its fair value, and it doesn't have any useful life. It's indefinite, and then it has not impaired. So we can just put at the side here intangible asset so we don't forget. The next information says, on the 1st of October 2006, Plateau sold an item of plant to Savannah at an agreed fair value of $2.5 million. Its carrying amount prior to the sales was $2 million. The estimated remaining life of this plant at the date of sales is 5 years. So now I'm going to highlight all the values of importance here. Based on what we can see that the parent sold to the subsidiary, right? And he sold it for a fair value of $2.5 million. And then the carrying amount that was originally in his books was $2 million. So as we move forward, I will show you guys how we're going to interpret this question. But we can call this intra-group transactions because this is a sale of an asset. It can also be a sale of a current asset such as inventory. So we're going to move on to the next question. And when we get there, I'm going to show you guys how to interpret this question and the best way to solve it. During the year ended 30th September 2007, Savannah sold a good to Plateau for $2.7 million. So now this is another intra-group transaction, and this time the subsidiary was selling to the parent. And Savannah had marked up goods by 50% on cost. Plateau had a third of the goods still in its inventory. At 30th September 2007, there was no intra-group payable or receivable. Now, these two questions I just read are intra-group transaction, and they are going to result to what we call unrealized profits. This one is going to result into unrealized profit, and this one too. It's just that since the parent was selling to the subsidiary, the way we will treat the unrealized profits for this one will be different from the way we treat the unrealized profits for this one because the subsidiary sold to the parent. Then the next additional information says, impairment test on 30th of September 2007 concluded that neither consolidated goodwill nor value of investment was impaired. So nothing was impaired. So we're just going to underline that so we don't forget. Let us write no impairments. Next additional information says the investments in equity instruments are included in Plateau's financial position above at their fair value on the 1st of October 2006, but they have a fair value of $9 million at 30th September 2007. So this was 1 year later. So let's see what the value was in our books. So this is investment in equity instrument, and it was $6,500,000 because of the thousands that are up, because of the zeros that are up, right? So now we can say that there is a revaluation surplus in this equity instrument. So we're going to take note of that and write revaluation surplus for this. It says no dividend were paid during the year by any company. So let's take note. No dividend. And then the last one says it is group policy to value the non-controlling interest at fair value. For this purpose, the share price of Savannah at the date should be used. So we're going to say non-controlling interest, NCI, at fair value. And what was the share price of Savannah at that date? We're going to go to the top. It says the market price of each Savannah shares at the date of acquisition was $3.25. So that's what we're going to use. So now we've read through the question and we've been able to interpret the additional information. So it's time to start solving. I'm going to give you guys a framework which I use to solve every of my consolidated financial position question. This framework helps you in a sense of direction so you don't get confused on what to start with and how to go about your solving. The question gives you a sense of direction to know the first few things you should calculate before you calculate any other thing. So let's get started. I call this framework GN. This is GNGURN. I call it good night Gurn. You can call it Gurn Gurn. You can call it whatever you want, but this is just an acronym that has helped me in my solving of consolidated financial position, and I'm sure it will help you too. So the first G in this means group structure, and the N means net assets of subsidiary. The G stands for goodwill. The U stands for unrealized profits. The R stands for retained earning, and of course this means consolidated retained earnings. And then my N stands for the NCI, the non-controlling interest. So this basically is a step-by-step framework on how you should take your solving, and this gives you a sense of direction. So once you see any consolidated financial position question, it's best to always start from your group structure, know your group structure, then calculate your net asset of subsidiary, then you move to your goodwill, your unrealized profits, retain earnings, and NCI. This gives you a sense of direction so you don't get stuck along the way. Before you start this, it is always important to first of all know your purchase consideration. So now we're going to use the very first thing that was given to us in the question to analyze our purchase consideration. So according to this question, it says that they bought 3 million shares. And these 3 million shares, how did they pay for it? One share in Plateau for every 2 shares in Savannah, plus a $1.25 in cash. Let's just write working one. Purchase consideration. So now they acquired 3 million shares for 1 share in Plateau for every 2 shares in Savannah. So that means they gave out 1.5 shares from Plateau, right? And this 1.5 shares they gave out from Plateau for acquiring these 3 million shares. What were the worth of these shares? They said these shares at acquisition date was worth $6. So we're going to do 1.5 million multiplied by $6, and this is going to give us $9 million. Then it now said plus $1.25 per acquired Savannah share in cash. So this was an exchange of shares. They gave out 1.5 million shares of their own Plateau shares to Savannah, and then they paid 1.25 shares for all the shares that was acquired from this Savannah. This is going to give us 3,750,000, and the total of this is going to be 12,750,000. So this is our purchase consideration. Then if you go further, remember that we read that they also acquired ACCA, which is 30% of shares in ACCA. in cash. So let's just do for Axel to come up here and write Savannah. So let's come up here and let's come here and write Axel. So now 30% times $7.5. This is 30% of shares of Axel at a cost of $7.5 per share in cash. So 30% of how many shares? So if you come here, we can see that Axel has 4 million shares. This is equity shares of $1 each. So the nominal price being $1 and the total price of the share being $4 million. So if you divide through, it means that it's equal to 4 million shares. So 30% of 4 million shares multiplied by the share price for Axel. And this will give us 9 million. So now, it later said here that only cash transactions in the above was recorded in the books. So if you go to the financial position, we're going to see investment in Savannah and Axel of 13,250,000. How was this gotten? It was stated that only cash transactions were recorded, right? And if you come to this, in the purchase of Savannah, the only thing that was cash was this. This was cash. And then in purchase of Axel, this was cash. So we are going to add these two values together. This is what is written as investment in Axel and Savannah. And they also said here that in addition, $500,000 of professional costs relating to the acquisition of Savannah are also included in the cost of investment. So if we add that 500,000 to these cash transactions, this is how the value in the books were gotten. We can come here and write working one. This is how the 13,250 million was gotten. So we've been able to calculate our purchase consideration for Savannah and our purchase consideration of Axel. Appropriately, this professional cost of 500,000 is not meant to be included in the cost of investment. Rather, we are going to minus it from our retained earnings when we are consolidating. So take notes when we get to the consolidation. So back to my framework. Now we've gotten our purchase consideration. We're going to follow this framework: group structure, net assets of subsidiary, goodwill, unrealized profit, retained earnings, and NCI. This way, we'll have a sense of direction, and solving this is going to be very easy and understanding. The first thing we're going to calculate is our group structure. So how do we know our group structure? So we're going to write working 2. Group structure. So now let's move over to the question. If Plateau acquired a total of 3 million shares from Savannah, what was the total shares available in Savannah? So you can go to the financial statements. In the equity side, you see the value of shares, which is $4 million. And then the nominal value of each of these shares of $4 million. I think we really talked about this when we were doing our purchase consideration, but we'll talk about it more. So since the nominal value for this $4 million shares is $1, if you divide through, that means the number of shares is going to be $4 million divided by $1. which is going to equal 4 million shares in number. These are the number of shares that Savannah had as a whole. And out of these 4 million shares, Plateau acquired 3 million. So we're going to do this is going to give us 75 percentage. So this basically means that the non-controlling interest, that's the interest in Savannah that Plateau does not control, is 25%. So let's just indicate here for Savannah. And then we're also given that Plateau also acquired 30% of shares in ACCA. We can go back to the question. 30% equity shares in ACCA. So now the percentage was already given, so we can come here and write 30%. So from this we know that Savannah is a subsidiary and ACCA is an associate. Drawing the group structure will be something like this. So now that we have our group structure in place and we know the percentage of ownership or control that Plateau has in the subsidiary, and the influence that Plateau has in AXU, we're going to calculate the next thing. So the next thing according to our framework is the net asset of the subsidiary. So we're going to come in and write working 3 So take note of how this is prepared. So this is written at reporting date, at acquisition date, and then at post acquisition. So now, when you hear the word net assets, most of the time what comes to your mind is total assets less total liabilities. In this case, that's not what we're talking about. When you write the accounting equation, which is what? Assets is equal to equity plus liability. If you want to get your net asset, this is calculated by saying assets less liability is equal to equity. So asset less liability is your net asset, and at the same time it is equal to equity. So your equity is also seen as your net asset. So in this case, when we say net asset of the subsidiary, what we're going to put here is our equity and other assets that we might find. So let's erase this. The way this net asset of subsidiary account is labeled, the very first column is going to be for the values at reporting date. The second column is going to be for the values at acquisition date. and the last column is going to be for values at post acquisition. So when I mean reporting date is that usually you know that the date that the subsidiary or the companies were acquired is not usually the date that you're reporting at. So the values of their asset at the date of reporting is what we're going to put here. And then the values of the asset at the date they acquired is what we're going to put in under their acquisition. For the post acquisition, we're going to have to minus the values from the reporting date and the values from the acquisition date to get only the things that were gotten after acquisition. We do this in order to calculate post acquisition profits. If you don't get this now, as we move forward, you're going to understand it plainly. But the reason we are calculating this net assets of subsidiary is because of it helps us to calculate other things that we need essentially for this. Net assets of subsidiary helps us to know the values that we're going to use for our goodwill and also know the values that we're going to include in our retained earnings. This is something important that we have to learn. It will not be actually asked or actually expected from you, but it's something that helps you with a sense of direction of what next to do and where to get your values from. So I'm going to go to the books now and write our values at reporting date. So in our financial statements, looking at Savannah, you can see that the equity of Savannah was 4 million, right? And then the retained earnings. The retained earnings as at 30th of September 2006 was 6,000, and as at 30th of September 2007 was 2,900. If you look at this, Savannah was acquired on the 1st of October 2006. There's no actual difference between the 1st of October of 2006 and the 30th of September 2006. They were basically the day after each other. That means this retained earnings here is the retained earnings as at acquisition, and the total of this retained earnings here is the retained earnings at reporting, because at this reporting date, which is 30th of September 2007, the retained earnings was a total of 6,000 plus 1,900. So this total of this is the retained earnings at reporting date, while just this 6,000 is the retained earnings at acquisition. Then our equity being this 4 million, which was stated here. Because of the 00 that is up. So like we said, the 6,000 was at acquisition, and the total of these two retained earnings is the retained earnings at reporting. So for us to get only the retained earnings that was gotten after acquisition, which is post acquisition, we will have to minus the retained earnings of reporting from the retained earnings at acquisition. We do this to get the post acquisition profit, and this post acquisition profit is what will be shared and be included in the consolidated retained earnings. You know the reason why we only include post acquisition profit in the retained earnings of the consolidated accounts is because we only want to share the profit that was gotten after we began ownership. We do not share the profit that was there before ownership. So we have to minus 8,900 from 6,000 to give us 2,900. You don't need to write anything here because equity remained the same and it was not increased after acquisition. So what next is expected to be here? So we're going to go through the additional information to see if there was any other asset that was valued at acquisition. Looking at this, you can remember the very first additional information that we identified as intangible assets. So let's read at the date of acquisition. That is a keyword to help you know that this asset was actually valued at the date of acquisition. See, at the date of acquisition, Savannah had 5 years remaining of an agreement to supply goods to one of its major customers. Savannah believes it is highly likely that the agreement will be renewed when it expires. The directors of Plateau estimate that the value of this customer-based contract has a fair value of $1 million. We say that the pounds is a mistake and it's actually $1 million, and an indefinite life and has not suffered any impairment. We identify this as an intangible asset, and one of the characteristics of an intangible asset is that it is identifiable. So this was identifiable. So we're going to include it in our net identifiable assets of the subsidiary while calculating our goodwill, because it is at acquisition. So going over to our net assets of the subsidiary, we're going to write customer contracts at acquisition $1 million. Now, what next do we have to record in this place? In our additional information, we noticed that there were two unrealized profits, and this unrealized profit will be minus from our retained earnings, but we're not calculating retained earnings right now, so we're not going to make use of those values yet. The next was no impairments, and then additional information 5 said the investment in equity instruments are included in Plateau's statement of financial position at the fair value on 1st of October 2006, but has a fair value of $9 million at 30th of September 2007. Now, this is a revaluation surplus, because if you look at the additional information, the investment in equity instrument, which was valued a year ago, was 6,500,000 as stated here. And now they're telling us that as at this date, we've valued it and it's now 9 million. So this is a revaluation surplus, and this has to do with our net assets. So this is going to come here, revaluation surplus. But this revaluation surplus occurred at reporting date, not at acquisition. So the valuation surplus of 9 million minus 6,500,000 gave us 2,500,000 as our revaluation surplus. So now this happened at reporting date, not at acquisition. So at acquisition there was no revaluation surplus. So it means that this is going to end up as a post acquisition profit. The customer contract was identified as 1 million at acquisition, so there was no increase in this value at reporting date, so therefore there is no post acquisition profit attached to this. We're going to leave this net asset like this because we have all we need to calculate our goodwill, and we're going to come back to this net asset of subsidiary to finish it up when we want to calculate our unrealized profit and our consolidated retained earnings. So I'm going to move on to the next working, calculation of goodwill. Let's call this working 4. So this goodwill is called goodwill at acquisition. So in calculating goodwill at acquisition, remember that you have to add your purchase consideration to your NCI and then minus your net identifiable assets as at acquisition date. So our purchase consideration, which we have calculated earlier at the beginning, was 12,750,000. Remember that this calculation of goodwill is for the subsidiary Savannah. You don't calculate goodwill for our associates. So the purchase consideration is 12,750,000. Then our NCI. Our non-controlling interest at fair value was given. And what was this? It said that we should value our non-controlling at the fair value of 3.25, which was the share price of Savannah as at acquisition date, which was given at the beginning. So now, how many shares does the non-controlling interest have? If Plateau acquired a total of 3 million shares out of 4 million shares, it means that the remaining shares for the non-controlling interest is just 1 million shares. So you can do this by doing 25% of the total shares, which was 4 million, multiplied by 3.25, which was our share price. And this is going to be 3,250,000. The total of this is going to be 16,000. Then our net identifiable assets at acquisition. So the easiest way to do this is just to come to our net assets of subsidiary and take everything that was written under the acquisition part, which was our equity, our retained earnings, and our customer contract. This is going to give us a total of 11,000. Therefore, our goodwill is 5,000, or rather 5 million, because of the zeros that are up. So the next part, or the next thing that we want to calculate, is our unrealized profit. Going back to our framework, we've calculated our group structure, we've calculated our net assets of subsidiary, we've calculated our goodwill, and now we want to calculate our unrealized profit. When we were assessing the additional information, I mentioned that there were two forms of unrealized profit here. So we're going to take them. This is going to be working 5. The very first unrealized profit, which was the sale of plant from Plateau to Savannah. Let's assess this. So Plateau basically sold Savannah a plant, and this plant was at a carrying amount of $2 million in its books, but it sold to Savannah at a fair value of $2.5 million. So now in Savannah's books, it's going to be written at $2.5 million, and then in Plateau's books, it's right that it sold it and got a profit of 500,000. Because of these two companies are consolidating to be seen as one company, we have to minus the unrealized profit in this sense, because if you look at it, there was no profit realized. It's like selling to yourself and recognizing that you made a profit of 500,000. That's not possible. So you have to recognize that there was an unrealized profit in this sense. And how do you do that? So now, when a parent sells to a subsidiary, the way you recognize an unrealized profit is usually different from when a subsidiary sells to a parent. So I'm going to outline that. Let's just go to our workings. Let's write A because it is the first unrealized profit. Parent to subsidiary. It was 2.5 million. It was 2 million in Plateau's books, and now sold to 2.5 million to Savannah. The unrealized profits that the parents recorded or that Plateau recorded is going to have been 2.5 million minus 2 million, which was 0.5 million or 500,000. Remember that this transaction happened at acquisition date. Let's go back. It said on the 1st of October 2006. So that was when Plateau first of all acquired Savannah. So let's just write here 1st October 2006. So as at now, when we are recording this, that particular plant has depreciated, and they gave us the method of depreciation and its useful life. So the method of depreciation for this particular asset was straight line depreciation, and it had a remaining useful life of 5 years. So we're going to calculate the depreciation as it relates to that particular unrealized profit. So we say that the amount of profit that was not actually realized, that was recorded by the parents, was 500,000. So this is going to have been 500,000 divided by the 5 years. 5 years being its remaining useful life. This is going to give us a depreciation of 100,000. So this company that now has this particular asset, which is Savannah, let me just write Savannah here. So Savannah already has this asset, and it's in its separate financial statement. It has already depreciated the asset after 1 year. So whatever value of plant is written in that financial statement right now is a depreciated value, because it has, after 1 year, it has already depreciated as normal. But what we're saying here is that there was an unrealized profit that was recorded in both parent and subsidiary. So we want to remove that unrealized profit, and since we've already depreciated, it has removed a part of it already, which is that 100,000. So what is going to be left that we need to remove is 500,000 minus 100,000, which will give us 400,000. So this is going to be our net unrealized profit. Let's take this again. I said that the unrealized profits from this was the 500,000 being 2.5 million minus 2 million. And this 500,000 was already recorded in his books as at the 1st of October 2006. So even since it was recorded in the subsidiaries books as at 1st of October 2006, after 1 year, they've calculated depreciation as normal. Assuming you were calculating depreciation on this 2.5 million, it would have been 2.5 divided by 5 years, which would have been 500,000. if we're using 2 million, it would have been 400,000. So because this 2.5 million is the value that is in the books of Savannah, when it depreciated a whole 500,000. So we're saying that in this 500,000 includes that 100,000 as it relates to unrealized profit. And that 100,000 as it relates to unrealized profit, it has been depreciated, it has been scrapped out. So now we want to remove the remaining unrealized profits for the purpose of consolidation. So that 500,000 that was remaining as unrealized profit, which we calculated here, minus the 100,000 that we've already removed as a result of depreciation, will give us 400,000, which is the unrealized profit that is left to remove. So now this is the unrealized profit. And then remember I first stated that unrealized profit as it relates to parent selling to subsidiary are treated differently from unrealized profit as it relates to subsidiary selling to parent. So I'm going to write an entry now. So if it's parent selling to subsidiary, it's going to be you're going to debit the parent retained earnings and credit the assets account in the consolidated financial statement. Debiting the parent retained earnings means subtracting it from the retained earnings, because you know that retained earnings is a credit figure. So if you're to debit a credit figure, means you are subtracting from that particular credit figure. And then the asset account, which is a debit balance in the consolidated financial statement, you are also crediting it out of there, meaning you're subtracting it from the asset account. So now we're going to treat the next unrealized profit, which is subsidiary selling to plant. Subsidiary selling to parent. Back to our question. Reading the question, it says, during the year ended 30th September 2007, Savannah sold goods to Plateau for 2.7 million. Savannah had marked up these goods by 50% on cost. Plateau had a third of the goods still in its inventory at the 30th September 2007. There were no intra-good payables and receivables. There not being any intra-good payables or receivables is a different concept or a different topic on its own. The intra-group trading is like selling between parent and subsidiary, which we are already discussing right now. But payables and receivables means like if a parent sells to a subsidiary and it is owing them or is being owed, those are where intragroup payables and receivables comes into play. But in this case, they did not say that anybody is being owed or anybody is owing. Rather, they're just telling us that there was a form of unrealized profit, in the sense that the goods were not all sold and therefore they had no realized profit from that particular good. So now, it said Savannah sold goods to Plateau, $2.7 million, and Savannah marked up these goods by 50% on cost. So once you see markup, it means that the profit element is already included in that cost. So 2.7 million, which is 2,700,000. And it says that at the end, Plateau still had 1/3 of this in its inventory. So 1/3 of 2.7 million is going to give us 900,000. So now he now said that this 900,000 is marked up by 50%. And whenever they say something is marked up, it means that the profit element is included in that cost value. So if the profit element is included in this selling or this cost value, to get the profit element, we're going to do 900,000 multiplied by 50 over 150, and this will give us 300,000. So this 300,000 is unrealized profit. So now, how is this 300,000 going to be treated differently from the way we said we're going to treat the previous unrealized profits? So now, remember that we said that the last one was parent to subsidiary, and now this one is subsidiary to parent. So now the entries for this is that you're going to debit the share of retained earnings to the parent's retained earnings, and then debit the share of retained earnings to NCI, and then credit the assets account. As we go forward and even when we consolidate, we're going to see this in practice. So the next thing that we're going to prepare now is our retained earnings, our consolidated retained earnings. So we're going to see how we're going to apply these to unrealized profits in this case. Before we calculate our retained earnings, we have to get our post-acquisition profits, right? And that's why I said that we're going to stop that net assets of subsidiary as at then and continue it later. So now we want to continue it and finalize it because we need the final values from it to continue our consolidated retained earnings. Here we're going to get our post-acquisition profit and continue solving. So right now we've already gotten post-acquisition profits of 29 and 25, and based on the additional information, that is the only form of post-acquisition profit existing. So we are going to finalize this account. So finalizing this account, what do? We're going to total all this. So this is going to give us a total of 11,000 here, and here is going to give us a total of 5,400. Working with this 5,400, this is our post-acquisition profits for our subsidiary. Remember that this unrealized profit here, the second unrealized profit of 300,000, because it belongs to the subsidiary, is supposed to be shared between the parent and the NCI. So this post-acquisition profit is also meant to be shared between the parent and the NCI. So what are we going to do? We're going to minus this 300,000 from here as our unrealized profits. $5,100,000. Now we are going to share this post-acquisition profits between the parent and the NCI. So 75% of 5,100,000 is going to give us 3,825, and the NCI, which is 25%, is going to give us 1,000 275. Now, so not to confuse you, I'm going to explain why we're minusing our unrealized profit from here. So remember that we said that this second unrealized profit, where the subsidiary sold to the parent, is going to affect the earnings of the parent only, and this one was going to affect the retained earnings of the parent and the retained earnings of the NCI. So if it is affecting the retained earnings of the parent and the retained earnings of the NCI, it means that it is affecting the retained earnings of the subsidiary. And you know that whatever belongs to the subsidiary must be shared 75% and 25% in this case. So now, that's why when we, after getting our post acquisition profit, assuming we decided to share this first for parents and then share this for NCI, and then get our, and since we know our unrealized profit, share this again for parents and share this for NCI. Whatever we got for the parents, if you minus it from the parent share of the unrealized profit, or we are going to get this same figure. To put it in practice, let me show you guys so you understand what I'm talking about. So this being our post acquisition profit, so 75% of this would have been 4,050, and then 75% of this would have been 225. So 4,050 minus 225 is going to give us 3,825. And if you have done that to get 25% of this and then 25% of this and minus it, it will still give us this. So what we did was, the whole figure minus the whole figure, then we now share this figure that we got into the parent and the NCI. So what I'm explaining is that we've already concluded the first part of this, which was debiting the share of the retained earnings to the parent and the share of the retained earnings to the NCI. So the next part now is to credit it in the asset account. We're going to do that when we're consolidating in our financial statement or financial position. So I'm going to erase this because it is not needed anymore. The next part of this is our working institutional consolidated retained earnings. So the first thing you're going to write is our parent retained earnings. So Plateau, which is our parent. So we're going to go to the statement of financial position and check what his retained earning is. So based on the financial position, his retained earnings is 16,000 plus 9,250, because that's the total retained earnings, and that is going to give us 25,250,000. Then the next thing we're going to do is we're going to less our unrealized profit. Now this unrealized profit that we're lessing was the first instance of unrealized profit when the parent sold to the subsidiary. So remember, in that case, we said that it is only going to affect the retained earnings of the parents. That's why we are subtracting it directly. So this is going to be the 400,000 that we calculated. For better understanding, you can see it here, where we said our net unrealized profits is 400,000. $25,250 minus 400 is going to give us a value of 24,850. Rather. And then now we want to minus the professional cost. Now I'm sure you are confused where the professional cost come from. So the professional cost was stated in the question in there where we said only cash consideration of the above investment has been recorded by Plateau. In addition, $500,000 of professional costs relating to the acquisition of Savannah are also included in the cost of investment. So remember that we said that inside this cost of investment here of investment in Savannah and AXU of this 13,250,000, there was 500,000, and that 500,000 we're going to minus it from our retained earnings because of the purpose of consolidation. So going back to where we came from, we're going to see less professional costs. It's going to be 24,350. So the next thing that we're going to do is now we're going to add our share of post-acquisition profits from subsidiary. The reason why I'm indicating subsidiary is because we're also going to add our share of post-acquisition profits for the associate. So what do we calculate as our share? Was 3,825. So coming here, 28,175. So before we go, I'm going to write here share of post acquisition profits for associates. So when we calculate that, I'm going to bring the figure here. So moving on to the next one, the next phase is the non-controlling interest. So we're going to write working 7. Working 7 are non-controlling interest. Our NCI, which we said had 1 million shares plus a fair valuation multiplied by a fair valuation of 3.25. The value of NCI was now $3,250,000. And then our post acquisition profits from the subsidiary. And what was the value of this post acquisition profit? We calculated as $1,275. Coming here, the value is now 4,550. 4,525 is our value of NTI. Now that we're done with this framework, we've done our group structure, our net assets of subsidiary, our goodwill, our unrealized profits, our retained earnings, and then our non-controlling interest. Because of the fact that this question includes an associate account or an associate company, there's one more thing that we have not that we need to include in this framework when it comes to associates. So this framework works for as long as it has a subsidiary, but when it comes to an associate, we have to include one last thing, which is what we call the equity method. Associates. So now the equity method. So that is going to be our last working eighth. So the cost of the investment in the associates was calculated as 30% of 4 million shares multiplied by $7.5. In case you are confused where this was gotten from, we calculated it earlier for our purchase consideration in we calculated area for our purchase consideration in our associates, which gave us $9 million. And then we're going to write here our share of post acquisition profit. Since we have 30% in this particular company, we're going to multiply 30% of the retained earnings after acquisition. So going back to the question, this is ACCA. And then our retained earnings as at 30th of September 2006 was 11,000. And then as at 30th September 2007 was 5,000. And this company was acquired on the 1st of October 2006. So it was only held for 1 year from and ended in 30th of September 2007. So our retained earnings that we're going to share, or the post acquisition profit that we are going to share, is just going to be this 5,000, rather 5 million, because of the zeros that are up. And this is going to give us a value of 1,500,000 and a total of $10,500,000. So now that we have calculated all this, it's time to consolidate. When I say consolidate, it means finalizing your financial statement, adding what needs to be added and removing what needs to be removed, and finalizing everything. So now we're going to start our consolidation. We're going to write consolidated statement of financial position as at the year ended 30th September 2007. So this is going to be $, $. So the first thing, our assets, non-current assets. So we know that consolidation basically means adding together the values, consolidating, adding the values together. So that's what we're going to be mainly doing, and then making adjustments for where we calculated an adjustment for. Now, the very first thing on the financial statement is our PPE, our property, plant, and equipment. And this property, plant, and equipment under Part 2, the value is 18,400 plus the value for Savannah is 10,400. Now, we're consolidating only the values for the parent and the subsidiary. We do not consolidate for associate because he doesn't have controlling interest over that associate. So it's just going to be the parent and the subsidiary. So 18,400 plus 10,400. And then we're going to minus the unrealized profit from the sales of plant, which was that 400,000. So this is the credit entry that we said we're going to do. And this is going to give us a value of 28,400. Just in case you're not clear, let's go back to our unrealized profits. The first one we calculated, we see that there are two entries: debit the retained earnings and then credit the assets account in the consolidated financial position. And the 400,000 is what we just credited. Now, crediting an asset account means reducing it from the asset account because the asset is a debit entry. The next thing that we want to write is our investment in ACCA. So remember that we said that we do not consolidate for associates, rather you write it out as an investment. So this is going to be investment in ACCA. So this investment in ACCA, the value is what? Remember we calculated our associates for equity method here and we got the value of 10,500. So that's the amount we're going to put here as investment in ACCA. The next thing we want is our investment in equity instruments. So here we write investments in equity instruments. And then remember we valued this to the value of 9 million. The next thing we want to write is that we calculated goodwill at the beginning. Calculated our goodwill as 5,000, rather 5 million. So this we're going to use. So this is what we're going to write goodwill 5,000. The next thing that we did, or next thing that we're going to write is our customer-based contract, the intangible asset that we identified from our additional information. So we're going to write customer-based contract, and this was $1 million. So this is the intangible asset that we identified from our additional information. Then the next thing that we are going to do is that we're going to total our non-current assets and get our value. So the total of this is going to be 53,900. Now we're going to write our current assets. The first thing in our current assets is our inventory. And what is the value of our inventory? We are going to add the two values for Plateau and Savannah, which is 6,900 plus 6,200 minus our unrealized profits. And our unrealized profit as at that inventory, that the second unrealized profit that we calculated from the inventory was 300,000. And then we get a value of 12,800. The next current asset that we want to write or calculate is our trade receivables. And we're going to add the two values of trade receivables here, which is 3,200 for parents and 1,500 for subsidiary. And that will give us a total of 4,700. The total current assets is 17,800. And the total of the non-current asset plus our current assets, which is our total asset, will give us a total of 71,400. So now we want to do our equity and our liability parts. Our equity, the first thing here is equity shares. We are going to do one more working as it relates to equity shares. We're not going to use the equity shares that was given to us in our question, which was 10,000, but rather, because of there was exchange of shares, we want to calculate how much shares it is now. So this, we're going to call this working 9. So remember that when they bought 3 million shares, they bought it for 1 for every 2 shares. So they gave out 1 share in Plateau for every 2 shares in Savannah, meaning that they gave out a total of 1,500,000 shares. So this 1,500,000 shares that they gave out was what the value as at that date of $6. And this is going to give us a total of 9 million. This 9 million, the nominal price of a share is 1 naira. So it means that there's a share premium on this 6 naira. So the nominal price of 1 naira times 1.5 million is 1.5 million. And then the amount of share premium, which is $5, because $6 is $5 in excess of $1, is going to give us $5 multiplied by 1.5 million is going to give us 7,500,000. So this 7,500,000, we're going to write it as share premium, and then we're going to add this value to our equity shares. So our equity shares that was $10 million before is going to be $10 million plus 1 11,500,000 is going to be a total of $11,500,000. So back to our financial statements. So our equity shares is going to be 11,500,000. And then our share premium. Our share premium that we just calculated is 7,500,000. And then our retained earnings is what is the value of our retained earnings? So let's go to our books. Share of post acquisition profit associates, we've not added that. We come to this, our share of post acquisition profit for associates was 1.5. So let's just do 30% of 4 million multiplied by shit, what am I doing? 30% multiplied by the post acquisition profit of 5 million is 1,500,000. So the total retained earnings for the group is going to be 28,175 plus 1.5, going to give us a value of 29,675. So this is the retained earnings. This is the consolidated retained earnings, or the retained earnings for the group. So we're going back to our financial statement. So this is going to give us, we're going to write our 29,675. And the total of this is going to give us 48,675. So on the equity and liability side, we're also going to write our non-controlling interest. And non-controlling interest here, what we calculated our non-controlling interest earlier, $4,525. That's what we're going to use here. So non-controlling interest of 4,525 is going to give us 53,200. Now our liabilities. Is going to be 7% loan notes as at the financial statements, and this 7% loan notes, adding that of both Plateau and Savannah, which is 5 million plus 1 million, give us a total of 6 million. And then our current liability, which is 8 million plus 4,200,000, give us a total of 12,200,000. And the total liabilities is 18,200,000. So 53,200 plus 18,200 is going to give us a final total of 71,400. And that's the end of our calculation. This is the solution to the consolidated financial position. So this is the end of this particular calculation. To have access to the file where this calculation was carried out, I'm going to be printing the PDF, and a link to access this question and the solution will be dropped in the description box below. Please, if you found this video useful, please ensure you subscribe, like this video, and leave a comment for us. We'll be waiting for you in the comment section to reply. Whether it is a suggestion or a request, we'll be in the comment section and be waiting to hear your views. Thanks for watching, and watch out for our next video where we'll solve another question on consolidated financial statement that has to do with deferred consideration and other concepts that you might find complicated in your studying of consolidated financial positions.